All right, guys. This is our first market update live. We're bringing it to everybody because we do these to different groups across Acadiana, but also to a lot of our agents and our team. So, in today's live episode of our market update, we want to give you some valuable insights of what's happening in the real estate market year to date. We have lots of changes, been a very dynamic market, and there's a lot of things going on, and we want to try to clear up and cut through all the noise so that you guys can take this information and use it to help your family or your business. I think we're getting all set up. This is our first live market update. Tommy, are we doing good?
We're doing great, Jim.
All right, well, great. So if you guys have any questions or want to ask or want me to dive deeper into any one of these topics, just let us know. Tommy's going to send me the questions in any kind of direction. So first thing I want to start off with is this QR code. This is our market presentation. Remember, this is a market update year to date, so it does change. But if you scan this QR code, you will get all of the slides on on my presentation. And I love to hear other people's comments. So if you think that something that we have is incorrect and want to challenge us, please do. That's all part of our learning and becoming better. So we'd love to hear from you. We'd love to hear some insights from all of you guys out there. If there is any questions, concerns, or you think we may have gotten something wrong, we'd love to hear it. All right. Well, with that, Tommy, I'm going to get going. All right. So here we go. This chart here is, from January to May, every year going back to 2013. So we got a decade worth of information here. And obviously you can see here, there's a huge unicorn. And when you look at 2022 compared to 2023 year to date, we are 34% less sales this year so far than the other than 2022. However, when you look at that in relationship to this trend line here is the average number of sales over the last 10 years year to date, and you can see we are just 3% off of the average. So some of the experts in the industries are calling these the unicorn years. We're probably never going to see in our lifetime, less than 2% interest rates or anywhere near that. So this was a very unique situation. We had to return to some normalcy at some point, and it looks like that's where we are going back to. What some would call normal based on the 10-year average as far as number of sales. There are some exceptions that in some certain areas that I'm going to dive into that we're not normal and we are abnormal compared to the last 10 years. And, I'll point that out to you shortly. But you can see here we're 34% off number of sales versus 2022 to 2023. But if you took the average of the last 10 years year to date, we should have been, around 1,278 sales for Lafayette Parish. I think I should tell you this is all Lafayette Parish numbers. We do have, numbers for across the state. So if you're interested in numbers in your parish or a certain area, just let us know. But here we go. So this is the sales. Now, when you look at the sales plotted on a line graph, it shows you a little bit more of what's going on. So you can see this brown. This is 2023. If you remember, if you've been following us for a while, in 2020, January 2020 was one of our best Januaries that we ever had. We went pre-COVID. We were doing phenomenal, more sales than we were ever anticipating. And then COVID happened and we had this fall, right? So this is where we were in 2020. We had this fall, and you can see it started to just accelerate after that, towards the end of the summer of 2020. Now, in 2023, you can see we're much further below 2021 and 2022, but in 2022, we started to see those high interest rates start to affect the market towards the midsummer and into summer, and you can see the sales started to follow the fall in the interest rates with the less demand. So what we're anticipating is that to cross over at some point in the towards the end of the year, and I'll get to that in a second. But this is if I take out the unicorn years and I just show 2017 and 2019, you can see our trajectory here is following right in line with pre-COVID numbers as far as sales. I mean, we're very, very close. You can see we're dead on 2000 in 2017. I mean, basically, we're following that same trajectory as 2017. We're probably going to see very similar numbers as pre-COVID, the 2017, 18, and 19 sale numbers. So it's going to be interesting to see how all of the variables play into this, because there are other things that we're not controlling, which is the Fed rate and the geopolitical atmosphere right now. So we'll see how it goes, but it certainly looks and feels a lot like pre-COVID times right now. This is what I wanted to show you. So this is from my friend Bill Bakke, who's the expert in all of the market updates, and I get a lot of my information from Bill. He had shown, and he didn't do this trajectory, but I'm going to share this with you. This is his chart. This was 2020 to 2022, and this is where we are in 2023 so far. You can see that we had much less sales than we did in 2022. However, this is what we can probably expect moving into the second half of the year. We're probably going to have a little bit less number of sales in June and into July. We're probably going to see a little bit of a dip, but towards the end of the year, we may even cross over somewhere between August, September, October. We may start to see us outperforming 2022. Now, why would that be? Well, we know last year we had a significant change in the interest rates. We went from literally 3 to 2.7, 2.5%, all the way up to 7%. At the beginning or the end of last year. So we saw this tremendous change in interest rate, which drove the sales down. And as the interest rates start to normalize, the demand starts to normalize, we're going to continue to see those sales increase. And, I'm predicting right here today that we're probably going to exceed 2022 sale numbers probably towards the end of the third or beginning of fourth quarter. All right, so now let's talk about volume sold. So this is dollar volume sold, which tells a little bit of a different story than the sales, and we'll talk about that in a second. But you can see we are below last year's numbers by 32%. So we sold 32% less dollar volume sold in Lafayette Parish than in 2022. However, when you look at the average over the last decade, the average was 279 million year to date, just under 300 million. And we are over that at 354 million. So although we were down almost 32% below last year, we were above what I would call the pre-COVID average over the last decade by over 26% or 26.9. So how could that be if we were less sales? And if you look at our sales, you can see right here that our sales numbers were only 3%. We're actually 3% below that average, and now we're 26% above that average in volume. Well, that's because our average sales price rose drastically since 2020 to today. Now that is starting to slow, and we'll get to that shortly, but that is why our dollar volume sold is so much higher than our actual number of sales. It's because the average sales price has increased and has been increasing, and it's not until the last 30 days that we're seeing it to really start to slow down month over month, but it's still higher than it was in 2022. So that brings me to pending. So pendings is how we want to look at, like, how are we doing and what's the future look like? Because pending sales, those are home sales that buyers actually put under contract and are expecting to close. You can see we're 23% below the pendings that we had in 2022. However, we are 5% above the average. So pre-COVID for the last decade is about 1,446 pendings. We are at 1,519 so far this year. And so we are expecting, to fall right in line with where we were in 2018, 19, and 20. And you can see these numbers are very close to these. So that's good news, for our housing market. It's, we definitely are still putting houses under contract. And I'm going to show you some data that's going to support this. The problem is, and we probably would have more pendings under contract today, but we just don't have the inventory. We're not listing houses at the same rate that we were, literally going all the way back to the 2000s. So that has been our biggest challenge. So although this number is below, 2019 and 20, it certainly is being affected by the current inventory that we have available for purchase. And if you're a realtor, you're out there, you're working, you have buyers right now that you're looking for houses, and there's just not enough inventory. Even though we have more inventory than overall inventory than we had last year, we're not replacing it at the same rate. All right, so here's our actives. So this is what I want to tell you. So actives, we do have more actives on the market currently. So this is the overall actives year to date. You can see that we're 28% more than we did last year at the same time as far as total actives available. But this isn't the whole story. It's the news coming onto the market is where we're really lacking. And there, that we have some, the experts believe that could be, the result of the low interest rates causing people to stay in their house longer if they've refinanced or purchased houses in 2020 through 2022. But you can see here, we're 28% above where we were last year, which is good. We need more inventory. However, we're still 43% less. That's almost 50% less than we were on the average in the pre-COVID. This significant amount. You can see 3,850 versus, in 2019 we had over 8,234 houses out that were available, in the inventory. Now, this is where we're struggling, and you can see this graph really shows why we need more listings on the market. You can see we're 23% less new listings this year than we were last year, and we're 21% less when you look at it compared to the average over the last 10 years. So, one thing, we're just not replacing that inventory as fast as much as our demand. So that is why, this is exactly why our average sales prices have sustained and have risen and continued to rise since 2020 actually. So we do need more inventory, and this is actually an indication of our demand is outpacing our supply, which is good news for the seller. So if you're thinking about selling, this would be a good time because there is low inventory out there. And I want to talk about that.
We have a question from an audience member
All right.
that has to do exactly with this. So Ethan Broussard asks, does a shortage in inventory mean that sellers can still sell for top dollar?
Absolutely, Ethan. So low inventory is going to, low supply means you're going to have higher demand. Now, you can see we have less new listings hitting the market. But if I go back to this, we have more overall listings this year than we did last year. But it's still less than what our demand is wanting. So we have more demand and not enough supply. That means prices are going to continue to rise, at least until the supply is balanced, and we are moving towards a more balanced market. And I'll get into the inventory here shortly, but it's obvious that now looks like the best time to sell if you are thinking about selling. The thing about it is you have a lot of sellers who may be locked into a 3% interest rate, and they might have had some life event that would have caused them to put their house up for sale, but they're holding off because they have that low interest rate. But the flip side of that is there's more equity. So, you may have a low interest rate. So to make a move to a higher interest rate to a larger house could be a challenge, but not necessarily now, because most people we're dealing with have more equity than they ever thought they had. So they can power that move with the equity that they have instead of the lower interest rates. So I know that's clear as mud, but I'm going to get to pricing and demand here shortly. So again, active, we need more, even though we have more active properties, we are really lacking the new listings. Now, I want to hit one other thing, and this is important because a lot of people would say, well, Jim, in 2021 and 2020 during COVID, we had less inventory in general. Yes, we did, but check this out. We listed more houses than a lot more houses. So what that tells you is, although we had more new listings hitting the market and our inventory was still low, that was demand eating up all of the inventory. So we had the same problem we had during COVID, which was lack of supply, but it was two different reasons. During COVID, we had strong demand that was just eating. It would absorb anything that came on the market immediately. Now, what we're dealing with is low demand but low inventory. So COVID, we had high inventory and overall higher new listings, but low inventory because the demand was absorbing it so fast. Now we're dealing with low inventory because we weren't providing that supply. So before it was demand eating all the supply. Now we're just not putting enough supply onto the market to really satisfy that buyer demand. All right, so moving on is the average sales price. We talked about this. So because of both, either way, during COVID and after COVID, it meant we had lower inventory and low supply. Anytime you have low supply and high demand, you're going to see prices increase. And I want to show you this. We in 2022 versus 2023, we're up 3%. So this 14% really is I'll get to that in a second, but we've increased year over year about 3% on our average sales price, right? But you can see we had this huge jump from 2020 all the way to 2022, where we saw some significant increases in the average price. And that actually came across through our volume. Our dollar volume sold was much higher. So average price in Lafayette Parish has increased dramatically over the last 3 years. You can see over the last decade, we really did have a very almost balanced market with what I would call normal. Um, and it wasn't until 2020 where we started to see that average sales price increase, and that was because of the high demand, low interest rates and high demand. Now, what this is right here is if you took over the last 4 decades, the average appreciation rate, which I'll show you a graph that Freddie Mac and Fannie Mae put together, but it's in on average, Lafayette increased about 2.8% per year appreciation. Well, if we were to apply that to the last 5 years, especially from going from 2020, 226, if we had a 2.8 appreciation, we would be around $250,000. This would be a more normal increase in the average sales price or appreciation, but we're 14% above that. So what that tells me is that, we are above average. We had some anomaly years. We've increased the average sales price because the high demand, and we do expect to have some flattening or normalcy coming up in the next few years. At least that's what the experts are predicting. But anyway, I think this is a great graph because it shows where we probably would have been if we didn't have COVID. Would probably be around an average price of 250. But this is that anomaly that has created the low inventory and the higher demand. All right, and so average days on the market. With that, when we saw the demand absorb all of the houses on the market in the last few years, we saw a significant drop in time on the market. You can see going back to 2013, our average days on the market was around 90 days. It bounced around between 80, 90, 100, 120 days. Now, and I do want to make this disclaimer, every house and every price range is going to have a different supply and demand. So this is overall for Lafayette Parish. So you can see we plummeted down to 27 days in 2022, and that was because the low inventory hit, basically a all-time high where we didn't have enough inventory to satisfy that demand, so they were moving quickly. Multiple offers, lots of multiple offers, lots of houses going above list price. Then, we're starting to move towards this. It's a trend. We're back up to about 61 days, which is 124% higher than we were last year at the same time. But we're still 31% below where we would be on average over the last decade. So, we do expect if we do get more inventory coming into the market to fill that demand, we do expect the average days on the market are probably going to continue to rise as we move towards a more balanced market. But if we don't get the inventory that we need to fulfill the demand that we have, even though it's lower than it was in 2022, we're going to continue to see those days on the market continue to stay low, well above the average over the last decade. All right, and here's another thing with this, because we experienced the low inventory and we had this buyer frenzy for the last couple of years. What you are also seeing is in the market, what we're seeing on our side is just because you put your house on the market doesn't mean it's going to sell for the top dollar. So we are seeing more houses fail to sell. There's more expireds. There's more canceled than there was in 2022 and 2021, which means you have to make sure when marketing your property, if you decide to go that route, to make sure that you're managing the over 100 variables involved in the selling process to make sure you're getting top dollar, and not only get top dollar, but also sell your property so that you can move to that next chapter of your life. So I just want to point that out is you are going to see more houses, and we are seeing houses sit on the market longer. And there's, price is just one variable. There's lots of other variables that you've got to manage that can cost you tens of thousands of dollars or worse, where you can't even sell your property.
We got a question just came in, Jim. It's from Leo Anderson. Question is, what are some of the things I need to do to get my house ready for sale?
Okay, well, the first thing I would say is, get a consultant. I mean, it's just like any investment. That is probably your largest investment, and it is for most people. What you should be doing is, number one, get a consultant. Get somebody, just like if you were entering or going to make some trades in the stock market, you really want somebody to advise you. But I'm going to give you a few pointers right now. Like, number one, presentation is everything. You've got to prepare your house for the market. So first thing is, you've got to act like it's not your house. You've got to go ahead and start moving all of the things that you need out of the house. Preferably you have a stager, or you're working with an agent that has a stager. She could tell you what to leave she or he can tell you what to leave in the house, so that you can stage it, so that when a buyer does come in, it can evoke some emotional triggers that could hopefully lead to an offer. So the things that we highly suggest is prepare your house, number one. The second thing is inspect your house. I know a lot of people out there say, well, the buyer's going to get an inspection. I cannot tell you how much money you can save and how many deals we have saved when we have a seller that's willing to do a home inspection prior to putting it on the market. Home inspection will, it will attract a higher offer. It's very similar to like Carfax. If you're looking for a car and you have cars that have the little Carfax icon and you click on it, it tells you all the history about the Carfax. Well, that's much more likely to sell than the ones that don't have the Carfax. And it's just because uncertainty creates fear, which creates hesitation and then eventually could kill a deal. So, the best things you can do is prepare your house, move everything else out of the house that you can, get ready for the market, so that your house is the one that's selling in 60 days and not the one that's selling not selling in 100 days. Professional photos, videos are really big right now. Making sure you have the absolute best photos, which requires more than a real estate agent. You really need to have a real estate agent that has a partnership with a professional photography company, and a lot of agents do have that. And then I would take it to another level and start to look at different things that you can make your house or your investment differentiate from all the other houses by offering different things, whether that's appliances or, in our case, we offer some of our packages. We're offering a Mexico trip for 2, all-inclusive resort, just to differentiate our house from the other houses. We also offer, whether it's video packages to really showcase your house, because we know, it's basically almost 100% of all home buyers are starting their search from online. So positioning it properly online and having the visuals to articulate the value and differentiate you from the other houses is going to go a long way when you're looking at the demand that is out there, so that when it runs across their computer, that they are compelled to set up a showing. I hope that helps. If you want more information, just reach out to me or anyone on our team, and we'd be glad to have a consultation with you and give you some good tips. So that's days on the market. Now, foot traffic. Okay, guys. So foot traffic, I've been tracking for many years. Foot traffic is the number of showings requested by realtors out there. So all of the realtors in Lafayette area and really across Louisiana use a company called Centralized Showing. Centralized Showing is how we set up all of the showings for when we're showing our buyers. Now, you could see pre-COVID, when we had more showings, that meant more buyer demand. I would call that foot traffic. But the last few years, I haven't been putting as much as much value on this foot traffic number, because we know we had the most demand in the last few years, but you can see the numbers of showings was a lot less. Well, why would that be? Well, we had less inventory because it was going so fast. So part of this lower number is an indication of the low inventory, because we know, and if you're in the real estate business, you're probably working with anywhere 3 to 5 buyers right now that have are pre-qualified, ready to go, but we're just waiting for the right house. So this is just a number I keep my eye on, and it wasn't until COVID where this kind of flip-flopped, where I would always see this relationship between foot traffic and pendings, which we're just not seeing it anymore. So anyway, I just wanted to show you guys this. Now here's where everything is. This is really we call inventory. This is really where you can see the supply and demand. This is where we get an idea of where the supply and demand is. Now you can see this line right here is like 5.5. That is really a balanced market. Anywhere between 5 to 6 months of inventory is a balanced market. Now, what is months of inventory? Months of inventory means if we were to take all of the houses, if we were to not list any new houses right now, so all of the houses that are currently on the market, and there's no new houses coming on the market, how long would it take for us to sell out of that inventory? Well, at 6 months of inventory, that's a balanced market. That's where supply equals demand. Now, anything below 6 months, you're going to see is a seller's market, meaning there's more demand than there's more demand than supply. So anything above 6 months, you're going to see is a buyer's market. There's more supply than demand. Now, we're talking in terms of Lafayette Parish, and I got to be really careful because our clients are across every price range. And I can't stress this enough. This is an overview of Lafayette Parish. This is not an overview of your property. You really need to look at the current inventory in your price range and in your neighborhood. It would be like me saying we have low inventory across the United States. That doesn't really tell you what's happening in Louisiana. So this is Lafayette Parish, but every neighborhood and every price range is going to be a little bit different. So if you are wondering how much inventory is in your neighborhood, our team will give you a free, no obligation, evaluation of your neighborhood, and we can send that right to you. This is not a sales pitch. I just wanted to let you know this is general market data for Lafayette Parish. Now you can see we are right here, and we were right around 3 months of inventory, for 2020, 21, and 20, all the way to 2023. So this is really COVID. And, we expect, as we get more inventory for the, to fill. So we're moving towards, 5 to 6 months of inventory. How fast are we moving there will be determined by how much new inventory comes into the market and how much demand is going to be applied to the market based off of the variables like interest rate, wage, the average wage in America and in Louisiana. So we're going to see a lot of, I would think we're going to see a lot more movement towards this normalcy. All right, so this is from Freddie Mac. This is our 30-year fixed mortgage rate. And you can see right now, this is based off of June. We are at 6.69. This anything above 7%, we have very weak demand. And we hit that at the end of last year, and we saw that in the number of sales. Really, were significantly less than they were last year. And we dropped down. We did drop down into the sixes, where we saw some more movement and we did see more sales, and we've had a few ups and downs. And that is because the Fed has raised interest rates. Now, they don't adjust the 30-year mortgage rates, but they can affect it by moving the 10-year Treasury yield, which then we're followed by. Let me see. Let me go there. So this is the 10-year Treasury yield. As it increases, which is this blue line, we typically see the 30-year mortgage rate increase as well. And that's how they're controlling the demand. And remember, their policy right now has been to really get a hold of inflation, is to stop and to really stop people from buying goods, and one of those is houses. So they're trying to limit and lower the demand for goods. And so when they raise these, you can see in the 80s they raised them significantly, and you can see the difference in the average spread. That's what's a little bit different right now. The average spread going back to 1972 between the 10-year Treasury yield and the 30-year fixed mortgage rate was around 1.7 to our 172 basis points. But right now, you can see since January, we're dealing with over 3.2 or 323 basis points in the spread, with an average spread of 2.9. So we typically, over the last 50 years, we've seen a spread of 1.7. So why are we seeing such a large spread in our between the 30-year fixed mortgage rate and the 10-year Treasury yield? Well, that is the uncertainty in the market. Part of this is uncertainty. Part of it is in the inflation. Part of it, this is where the banks have the ability to come down, and as things start to tame itself, which, as you know, as of today, last week, the Fed has decided not to increase the interest rates moving forward as of right now. And if that continues, I would expect, even if they don't decrease the interest rates, we still have a significant amount of room for the interest rates to come back down to a 1.7 spread, or even 2. Let's say even if it was a 2.5, you could see we're going to be well above 6%. Even if interest rates stay exactly where they are now, we can be under 6% if things start to have a little bit more stability in the with the Fed rates, and also the inflation, and it also has to deal with the wars and wage growth and all of that. So we have a lot of room, guys, to come down on the interest rate. So I would not be surprised that even if the Fed does not increase the interest rates, that we would see a dip in our 30-year mortgage rates. Now, so where's interest rates going? So let's check that out. Now we take Fannie Mae, the Mortgage Broker Association, and National Association of Realtors, and we get all of their predictions, and then we take an average of that. And then I take Freddie Mac and I plot that on a separate chart as well. But what you're seeing here is in the quarter three, when you take the average of all three of these experts, we're looking at right around 6.1%. The end of the year, they are predicting that we should be under 6% at 5.8. And if you go back to this, if we get under 6%, this is very strong demand. You can see, very weak demand if we're above 7, limited buyer demand between 6.5 and 7. We have good demand around 6 to 6.5. But if we're under that 6 mark, which we have the room to make it under there, we could see very strong demand, which means we're going to need more listings. All right, so this is what we're looking at. Quarter three, they're looking at somewhere around 6%. Quarter four, we could be around 5.8, and then next year, quarter one and quarter two of next year, they're looking at in the mid 5s. Now, this is from Freddie Mac. What does Freddie Mac think? Well, if you look at quarter 3 of this year, they're thinking around 6, quarter 4, 5.6, quarter 1 of next year, 5.5, and as low as in the second quarter of next year as 5.3. That would be, really, I would consider that as normal interest rates for what we've seen over the last few decades. And so, what does this all mean? Well, just real quick, I want to show you this chart. This is an appreciation chart that shows going all the way back to 2002. You can see that in Lafayette Parish, if you bought a house in 2002, you would have seen, as of today, over 100% increase in appreciation. That is really phenomenal for any type of investment. If you invested in something in 2002 and it's now double what it would be worth, in 2002, it's really staggering. But where the real numbers, start to grow, you're talking about, like, if you bought, let's just say, a $200,000 house and you put 5% down. So you bought a $200,000 asset with 5%, with $10,000. Now that asset is worth $400,000 and you only put $10,000 down. So that it's very hard to even comprehend the increase in wealth when buying a house, because you're leveraging $10,000 to buy a $200,000 house. So I would encourage all of you guys, and I encourage everybody, to buy as much real estate as you can, if you want to create generational wealth. That's how it's done, is through real estate. And I would say, you could see here, we've had, like, all the way up to 2007, 2008, we had some flattening of our appreciation, which we're going to see. And I would be surprised if we don't see a flattening in the average sales price following a significant increase in the average sales price. So you can see that this is where we are at the end of 2022. So I would expect to see more normalcy over the next few years before we have another big increase in that. But it's all determined by supply and demand. And right now, what does all of this mean? If you're a buyer right now, what does this mean for you? Well, what it means is, if you need to buy a house, interest rates are lower than they were at the beginning of the year and at the end of last year. So you're getting a better interest rate. Although we have low inventory, sellers are definitely more reasonable than they were during COVID. We're not seeing the multiple offers as often as we are, or as we were last year. I had a lot of buyers last year that worked with our team, and they really just gave up. And so if you're one of those buyers who gave up last year because there was just too much competition, this would be a time to get back into it. It's much more reasonable than it was during COVID. And if you're a seller, what we're starting to see, guys, is we are expecting this to slow down or even stop. We've seen, even this month, our average sales price really starting to dip below where it was last month. So although we're 3% higher than we were last year, it looks like we could be at the peak of this price increase. So because we still have low inventory, I would highly suggest, if you're thinking about selling anytime soon in the next 12 months, I would highly suggest you get a start on it now. Do it while we don't have a ton of inventory out there, because I would not be surprised, and the experts that I'm talking to, we believe there's pent up supply that's on the market where, because of the very drastic increase in the interest rates, and it has created some fear and uncertainty, which has prevented people from entering the market. But I'm going to tell you, people are still having those life events that are causing people to want to upgrade or downgrade. We have a large population of empty nesters and baby boomers who will be putting their house up for sale. And it could happen any day now. And then we also have a lot of people who are holding off until interest rates, get just a little bit better. And if that happens, they're going to list their house, and you're going to see a lot more competition. So if you're thinking about selling, I would sell now. And if you're thinking about buying, look, we're not going to see, 2.5% to 3% interest rates anytime soon. So, you really have to just get comfortable with your the note that is available today, because you can always, if it does go down to, below 5%, we can always refinance, if the interest rates do go below where they are today. Well, that is one more slide. What's your alternative? Well, you can rent. Well, this is what happens with rent. Since you can see, since 1988, rent has continued to increase. And with inflation, rent continues to increase. So, we don't expect rent to go down. So if you are renting, you need to start to plan and get ready. Even if it's 2 years from now, I would start today. It's never too early to start to plan for your future in order to build your generational wealth, and your assets. So with that, I really enjoyed doing this live, Tommy. Hopefully we'll do it again. I really wanted to do a deep dive, and I wanted it to be very time sensitive to what's happening today. So I hope you guys enjoyed it. If you have any questions, or if you want me to follow up with you, or if you think I got some of this wrong, let me know. I really want to know. By the way, if you want to follow us and see all of our market updates for every single city or parish that we do in Louisiana, you can follow this QR code, and we put it out on a monthly basis. So with that, I think that's it. Unless there's any other questions, I'm Jim Keaty with Keaty Real Estate. I really appreciate you tuning in for this live market update, and I look forward to seeing you next time.